While the West is busy arguing about candles and profit-taking and bubble popped, something else is happening in the background that's way more important. China is quietly turning silver into a retail obsession. And I'm not talking about a normal people bought some coins situation. I'm talking about a full-blown Chinese retail trading frenzy happening in real time, using China's pure play silver funds as the on-ramp and an arbitrage story that's spread like wildfire. And here's the part that should make you sit up. When a market is falling in the West and the East is piling in at record speed, that's not just demand. That's fear of missing inventory. That's people trying to front-run 2026. That's the kind of desperation that tells you the story is bigger than a chart. So today's video is called China's Silver Trap, the secret buying frenzy propping up prices. Why is the East so desperate to own silver before 2026 begins, while the West keeps selling? And I'm going to break this down like a crime scene, not hype, not slogans, signals. Because if you misunderstand what China is doing right now, you are going to misread every move silver makes next. And silver, when it starts moving like this, doesn't just punish mistakes, it punishes confidence. Let's go. Reports from the last couple hours have been pointing at the same thing. A Chinese retail trading frenzy pushed silver to record highs by channeling money into China's pure play silver funds and exploiting an arbitrage narrative. Let me translate that into normal language. China found a loophole-shaped story. Retail got obsessed. Money poured into a narrow doorway, and the pressure from that doorway leaked into the global price. That's why you saw silver hit insane highs and then swing violently, because this wasn't a calm institutional repricing. This was a crowd stampede through a small gate. And that is exactly how you get sudden spikes, huge premiums gaps, reversals, and price action that makes normal traders look like amateurs. Now here's the important part. If you think this is just China gambling, you're missing the deeper signal. Because Chinese retail doesn't pile into a hard asset trade like this unless there's a reason. Sometimes that reason is pure mania. But sometimes the reason is something more dangerous. They're buying because they think the real supply window is closing. And with 2026 staring everyone in the face, you should at least consider the possibility that China isn't just chasing profit. China is front-running a supply regime change. Why this is called China's Silver Trap. When I say trap, I mean two things at once. Trap one, the obvious trap for late retail. When retail crowds pile into a fund that starts trading at a huge premium, the last buyers become the exit liquidity. It feels like free money. Then the rules change. Subscriptions get halted, limits get tightened. And the people who arrived last learn what maximum pain feels like. That's the surface level trap. Trap two, the real trap for the West. This is the part nobody wants to say out loud. While Western markets are still treating silver like a tradable commodity, China is starting to treat silver like a strategic possession, a get it now or regret it later metal, and that shift, when it happens, doesn't show up first in headlines. It shows up in behavior, aggressive buying during volatility, persistent premiums on shore, a spread that refuses to close, and a retail base that refuses to stop pressing. That's a trap for the West because the West is still playing paper logic, while the East is drifting toward physical logic. And when those two logics collide, paper gets exposed. The mechanism, how a Chinese fund can move a global metal. Let me explain the plumbing, because this is where people get hypnotized by the wrong thing. A lot of people see Chinese retail buys a fund, and they think, okay, cute, that's local. No. If the fund is linked to silver futures exposure, and if the managers and market makers need to hedge inflows, then retail demand can translate into real pressure on futures pricing. And futures pricing, especially in a tight global market, can tug spot around like a dog on a leash. So what does this look like in real life? Step one, a pure play silver fund becomes the only easy doorway. If you're a Chinese retail trader and you want clean silver exposure, you don't have 1,000 perfect instruments. So when one instrument becomes the silver doorway, it becomes a magnet. Step two, social media turns a doorway into a stampede. Someone posts the strategy. The post spreads. It becomes a meme trade. Now it's not about valuation, it's about speed. Step three, the fund starts trading at a premium. When too many buyers pile in and the creation-redemption mechanism can't keep up or gets restricted, fund price can detach from underlying value. That's how you get a fund trading wildly above its asset value. And that's where arbitrage becomes the bait, because everyone thinks they can capture a free spread. Step 4. The hedging and underlying exposure pulls on futures. More inflow means more need to maintain exposure. More exposure demand means more pressure in the underlying market. And if onshore demand pushes Shanghai prices up, you get the next signal. Step 5. The Shanghai-London spread blows out. This is the part that should make you uncomfortable. If Shanghai is pricing silver materially above London, it means there is a local urgency to own silver exposure that the global market can't instantly satisfy. Normally, spreads get arbitraged away. But if capital controls, logistics, and rules make it difficult to move metal or positions across borders fast enough, the spread can stay wide. And when spreads stay wide, it tells you the market is not one market. It's two markets. And one of them is panicking. That is not nothing. That is a flare in the sky. Why the East is buying while the West sells. Now let's talk about psychology, because the West and the East are not living in the same emotional environment. In the West, silver is still treated like a trade. People bought the rip. They got scared by the wick. They took profit. They reduced risk. The West sees volatility and thinks, get me out. In China, silver is increasingly treated like a position, a store of value, a hard asset, a strategic hedge, a way to escape certain risks that don't show up on a silver chart. China sees volatility and thinks, if this is the last window before 2026, I need exposure now. So when you ask, why is the East so desperate? Here are the real-world drivers that can create that desperation. Driver 1, 2026 anxiety, policy and supply regime shifts. When a market believes rules are about to change, export rules, licensing rules, supply chain rules, import rules, people don't wait for confirmation. They front run, because the best deals are always before the gate closes. Whether every rumor is true or not, the psychology is consistent. If the crowd believes supply access might tighten, they buy first and argue later. Driver 2. Physical reality beats paper logic. Silver is not just an investment metal. It's an industrial artery. Electrification, electronics, solar EVs, data infrastructure. When the world is building more machines, silver demand becomes less optional. China understands this deeply because China lives inside manufacturing. So the East sees silver not as a chart, but as a component that powers the future. Driver 3. Household trust shifts toward hard assets. When people feel uneasy about property, currency, or policy risk, they move into things they can understand. Gold is classic. Silver becomes the gold for the masses. More volatile, more affordable, but still a hard asset. And once the retail base chooses a hard asset, it can become sticky because they're not buying for a 2-hour trade. They're buying because they don't trust something else. Driver 4, they're not trying to beat the market. They're trying to beat time. This is the core concept. Western traders try to beat price. Eastern buyers might be trying to beat time. And when people are trying to beat time, they don't wait for dips. They chase. That chase is what props markets up during moments when you would expect them to fall. The fund frenzy is not the whole story. It's the symptom. Now, I want to be very clear. A retail frenzy can be dangerous. A retail frenzy can blow up. A retail frenzy can create bag holders. But here's what smart people miss. Even if the fund trade itself is frothy, the desire behind it can be real. The froth is the delivery system. The desire is the signal. So you have to separate the instrument, which can get overheated, from the intention, which can be structural, because the intention is what can carry a trend longer than anyone expects. And the intention is what makes 2026 such a big psychological marker. Why this props up prices? Even when silver should be resting after a big run, markets usually need to cool off. They pull back, they consolidate, they breathe. But when you have a pipeline of new buyers who are not sensitive to fair value, you get a different behavior. You get a market that refuses to stay down. The West sells a dip. China buys the dip. The dip gets absorbed. Then the West looks at the chart and says, why isn't it collapsing? Because the buyer is not the same buyer. If China's retail pipeline is active, dips become inventory events, not fear events. That's how you get a market that keeps reinflating after every flush. And that's exactly how you trap shorts, because shorts keep saying, it can't keep doing this, and then it does it again. The big question, why before 2026? Let's talk about the before 2026 begins line, because this is the heart of your topic. If a crowd is desperate to own silver before a specific date, it usually means one of two things. Option A, they expect access to change, maybe supply routes, maybe export policy, maybe delivery terms, maybe domestic restrictions, maybe industrial stockpiling. Not all of it has to be true. The crowd just has to believe that something changes soon. Option B, they expect price discovery to get nastier, meaning once the calendar flips, you can't rely on calm liquidity. You get gaps, you get administrative measures, you get more restrictions, you get forced behavior. And the crowd is trying to get positioned before the market turns into a survival game. Because the first rule of survival markets is when everyone wants the same asset at the same time, you don't get it at a fair price, you get it at a desperate price. So if you believe that 2026 is when the desperate price era begins, you buy before it begins. That's the logic. And China is acting like that's the logic. What this means for shorts and why the West keeps getting trapped. Now let's talk about shorts, because I know a lot of you watching are thinking, okay, if the West is selling and China is buying, I'll short rips and cover dips. That strategy works in normal markets. This is not a normal market when onshore demand is creating persistent premium pressure. Because if the Shanghai side keeps bidding, it creates a floor under the global narrative. It doesn't mean price can't drop. It means drops can be violently bought, and that's where shorts die. They don't die because they're wrong long term. They die because they get squeezed short term. Silver doesn't need to go to the moon to destroy shorts. Silver just needs to do repeated rude moves. Rip up fast, refuse to stay down. Spike volatility trigger, risk controls, force covers. If China is providing the dip bid, it makes that cycle more likely.